Here we go with the INE FX window clock in 1 year. We started the conversation yesterday, setting the tone for the rest of the week. One of the major market incidents, or what you call the event, was the INE window. Whichever way you look at it, whether it is a perfect, it's yet perfect, or it's not yet perfect, it's on the way, we need to consolidate it, whatever you think. There was some major pull by the central bank just about a year ago. This time, last year, we were all grappling to understand what the new INE window really was. It was a blue ocean for every one of us, including the central bank itself, who had, well, just felt something got to be done. They haven't tested it before. I'm not sure they had a real idea of how it would work out, but with some measure of faith and faith, where we are today. That window has about 46 billion US dollars in just 12 months. Eronmosele Aziba, from one of the investment analysts at Afrinvest, is joining us this morning to expand this conversation and taking it into the debt market. That will include, of course, the conversation around Eurobond offerings, both sovereign and corporate. Good morning.
Good morning, boss.
It's good to have you. Let's
Thank you.
a step back a little bit. What was on the mind of you folks at Afrinvest a year ago, this time just last year, when the central bank came up with that policy on the 21st, and a few days later, FMDQ said that we're starting trading? What were you guys thinking of about whether was this a gamble? Was this well thought out, or was just as the spirit directs?
Yes, so like you mentioned, the circular on the launch of the window was actually released on 21st of April, which was a Friday. So we had the weekend to at least try to digest it and understand what it was. But from all indications, especially one key thing to note was the fact that rates at this market were going to be market determined. So forces of demand and supply were going to determine rate. For investors who want to bring their funds in, they can bring it in through this market. For exporters as well, who might want to convert their foreign earnings into Naira, they could trade in that market as opposed to going to the parallel market. So it was, we could see that it was largely positive, and it was greeted with a lot of optimism. I mean, we saw the impact across the various markets, especially the equities market. I've started to see a lot of foreign portfolio inflows start to come back into the market.
But then you analysts must have had a very difficult time. If you look at the months before the INE, last April was like, what exactly are we doing with the central bank taking control of the FX market and try to drive it from within? Much different from what we had before, in which we just had our weekly auction. You bring your Naira, you get your dollars, everybody's happy, the central bank is happy. Well, happy, in quotes as it were, whether that hurts the economy. But again, we had a major problem of backlog of uncleared remittance, of uncleared dollars, and a lot of dollars locked up in domiciliary accounts, which it looks like every day we're just trying to get something done. And the whole world was looking at us, and the central bank in particular. Hey, folks, what are these guys up to, really?
Yes, so the major issue started with the crash in global oil prices, which started in the second half of 2014, in a bid to sort of keep the FX rate at certain levels. We had to see a lot of intervention from central bank, and we saw the impact of this on the external reserves. And for us analysts and even foreign investors, looking at the state of the market at that time, it was clear that it was rather unsustainable for the CBN to continue to defend the Naira at that level, like I mentioned, with the impact it was having on the external reserves. So it was clear that there was a need for some flexibility in the market, a situation where you can boost investor confidence, try to attract foreign inflows back into the market, because the CBN remaining the major supplier of FX into the market was becoming very unsustainable. And like I mentioned, we saw the impact on our external reserves. In terms of looking at export cover, which sort of measures number of months of import cover, sorry, which sort of measures the number of months your current external reserves, number of months of imports your external reserves can cover. We saw it fall to as low as about 3 months thereabout, which was a very threatening level.
It was a danger zone.
It was a very dangerous
We're now
level.
in 14 months, then we're around 3. Then,
Yes.
well, somehow we got about a 6 months cover. Anything below 11 months, in fact, anything below 21 months.
It starts to get worrying, but that also gave credence to the fact that the drive of the CBN to maintain rates at that level at that time was quite unsustainable.
Yes, but again, what does the thinking at the debt market back then as to how would this new foreign exchange experience impact on those who are holding the naira assets of our fixed income and those holding the dollar asset?
Yeah, so the impact that we've seen on the dollar assets, for instance, we started to see the CBN, the government approached the international debt market for issuance of Eurobonds, if you recall. Prior to the first one that was issued in February of 2017, last time we had any issuance of any Eurobond was in 2014. We could see that there was some sort of renewed confidence and renewed interest in our domestic market. And with the improvements that we started to see in oil prices, we saw oil production volumes also improve. We saw the impact on external reserves, which led to improved confidence levels. We started to see foreign inflows trickle back into the market, which meant that the government had the confidence to be able to approach the market to raise debt, and we saw significant interest in the issuances, all oversubscribed during the year.
We lost some major shirts, as it were. 2014, 2015 was a year, of 2016 was a year we would like to forget, but not in a hurry, because we lost almost everything in terms of how the world looks at us, at Nigeria, as a country that has what it takes to put dollar on the table for whatever transactions. Airlines were on our neck, crying every day they're going to stop. They were threatening. All of them were threatening not to come to Nigeria anymore, and some folks were scared. But again, we lost our JP Morgan dollar index. Then the Barclays guys followed. They kicked us out on both fronts because we couldn't perform, as it were. Do you think we are in a position right now to get back into both the JP Morgan, EGBM, and the Barclays index?
Definitely, with the improvements that we've seen in FX supply, because then the major reason for the eviction from these indices was tied to the current FX market situation. Now that we've seen improved stability, we've seen improved FX supply, external reserves remain robust, all the indicators currently point to sustained foreign inflows into the market. We believe discussions on a re-inclusion into these indices should pick up now, and we expect them to be largely successful.
But if we go back a little bit to the new FX market and the Eurobond offerings, for the corporates, it looks like the I&E window provided a major fillip for one, their own appetite to step out, and for foreign investors to buy in.
Yes. So similar to what we saw with sovereign Eurobonds, where the last issuance that we had was in 2014, across the corporates also, although we had one from Access Bank in late 2016, but for three other corporates, so you had Zenith Bank, UBA, their first Eurobond, and Fidelity also approached the market in 2017. And this was largely hinged on the fact that there was renewed investor appetite for these instruments, given the attractive yields. Across, even looking at the sub-Saharan region, the Eurobonds market generally, considering the largely easy monetary policy across most global central banks, we saw a lot of interest in emerging market instruments in 2017 as investors sought for higher returns. And this also fed into the renewed interest that we saw in our instruments, which can be reflected in the oversubscription that we saw on the instruments as well.
Very quickly, as we are having this discussion, news just coming in from Bloomberg that Dangote Cement says it's considering a listing on the London Stock Exchange with $500 million US first offering. That is coming through from Bloomberg as we speak. If you're online, you can see that. You can go to Bloomberg so that you can follow on Twitter. You know how to find this news if you're in the market. Now, Dangote Cement 2 days ago announced the appointment of Cherry Blair, the wife of former British Prime Minister Tony Blair, his wife Cherry Blair, on the board as a non-executive director and a former chief executive officer of Extrata. Extrata is one of the world's leading mining company. Davis is now also on the board of Dangote Cement PLC, also as a non-executive director. They had a confirmation of Joseph Makoju as a full chief executive officer of this largest company listed by shares on the Nigerian Stock Exchange. Now, this company, Dangote Cement, says it's considering an IPO. The first offering by one of the Dangote Group companies, Dangote Sugar Refinery, a few years ago, the $350 million US. Now, the cement company, that's around 2007, 2008. Now, the cement giant says it's looking at $500 million first offering on the London Stock Exchange. Part of the conversation will start today on the show, and of course we'll continue when this such a big news hit here. We have about 8 Nigerian companies listed on the London Stock Exchange with a total market value of about $6 billion US. Back to Eronmosele Aziba from Afrinvest. This is good news. Let's just divert a bit, because if you do this offering, this good is going to be shares.
Yeah.
Yeah, isn't it?
Yes.
I'm sure you folks will be.
It's definitely going to be positive. With, like I said, with the renewed interest that we're seeing in emerging market instruments, and also looking at the performance of the company itself, we expect it to be largely successful.
Yeah. So if you look at these offerings, whether it is on the equity side or on the debt side, it all points to one thing: how your FX market is playing out.
Essentially, so we can say that foreign inflows are still a major determinant of most of the activities that we see in the market. So if you look back at 2017, so as we saw renewed interest in our market and FX inflows start to improve, the economy came out of recession and started to see improved activity across various sectors. If you look at inflation, also, we started to see that moderate steadily due to high base impact from the prior year, as well as lower cost pressures on the part of manufacturers. We're also looking at indicators like manufacturing PMI as well, also improving. And all these factors have coincided with the launch of the investors and exporters window, which goes to show the positive impact that it has had on the general performance of the economy as a whole.
Now, if we try to wrap up this side of the Eurobond conversation, we're looking at some folks are saying in 2018 we're looking at 2.5 up to $3 billion in Eurobond offerings. Do you think we should still do more in this market?
Well, the government has already, the DMO, CBN as well, has already pointed towards more focus on foreign borrowings as opposed to domestic borrowings, which we saw in the prior year, due to the fact that foreign borrowings are more longer termed borrowings, and currently at a lower cost to what you have in domestic market here. So we expect interest in foreign borrowings to remain upbeat in the year.
Yeah, but again, we'll need to watch something very quickly. The interest rate is going up in the U.S., and the U.S. 10-year is now 3%.
Yeah, so that's another factor that we would need to watch out for, with higher interest rates from these developed markets, central banks. This could impact on our interest.
And 10-year treasury at 3% plus? 3%. Oh my. That's putting the Fed on the edge of the chair, and everyone will be thinking what to be done. Let's keep Eronmosele Aziba here for after the break to discuss a bit of this earnings digest and the news hitting the street. Dangote Cement is reporting it may list on the London Stock Exchange in the next 2 years. That's not fetch a distance if you're in the market. You could just keep your mouth ready for $500 million. Have a size of that.